Welcome to the video. First, we will set the stage by naming the central problem. Using a 529 plan for K-12 private school can look attractive federally, but often fails at the state level. This introduction frames the core tax trap so viewers know what to watch for and why it matters. Next, here is our roadmap. We will begin with a quick primer on 529 basics, then unpack state conformity and recapture rules. After that, we will walk through a numerical example to show how the net benefit can vanish. We will compare the value of K-12 spending versus college savings, provide a practical checklist, test understanding with a quick quiz, and then close with key takeaways and next steps. To begin, let us clarify what a 529 plan is. A 529 is a tax-advantaged account intended primarily for college and higher education expenses. Under federal law, you can use up to $10,000 per year for K-12 tuition. However, states do not have to align with this federal rule. Some states do not recognize K-12 as a qualified expense and may tax earnings or even claw back state tax breaks. Before diving deeper, let us define essential terms. We must differentiate federal qualified expenses from state recognition. State conformity is whether a state mirrors the federal list of qualified expenses. Many states offer a deduction or credit for contributions. Recapture means the state can reclaim that tax break if the funds are used in ways the state does not qualify, such as K-12 tuition in a non-conforming state. Our goal is to calculate the net benefit after all these factors. Now let us visualize the mechanics. You contribute to a 529, invest, and ideally enjoy tax-free federal growth. Distributions for college usually qualify at both levels. By contrast, K-12 distributions are federally permissible up to $10,000 per year, but state conformity is not guaranteed. If your state does not conform, it may tax the earnings and potentially recapture any state deduction or credit you claimed. This can reduce or erase the benefit. Moving on, let us weigh K-12 spending via a 529 against saving for college. On the K-12 side, there might be a state deduction and federal permission, but the risk is that your state does not conform, creating recapture and state tax on earnings. On the college side, the framework is better aligned with both federal and state rules, allowing long-term compounding and a lower chance of recapture. As a result, the return on investment tends to be higher for college savings. Continuing, here is how the conformity trap plays out. You contribute and then immediately withdraw for K-12 tuition. Some states will reclaim the state tax benefit through recapture, and non-conforming states may also tax the earnings. The combined effect is that your supposed benefit can disappear or even turn negative, especially when factoring in administrative time and potential penalties if mishandled. Furthermore, state policies generally fall into broad categories. Full conformity means K-12 is treated as qualified, and the process is relatively straightforward, though you must still check limits. Limited conformity means partial or conditional recognition, with nuanced definitions and timing rules. No recognition with recapture is the most problematic category, often resulting in zero or negative net benefit for immediate K-12 withdrawals. Finally, in states with no deduction, the state-level incentive is minimal, so the federal rule is the primary consideration. Next, consider a numerical illustration. Suppose you contribute $10,000 and receive a 5% state tax benefit worth $500. If you immediately withdraw for K-12 tuition in a non-conforming state, you may need to repay that $500 through recapture. Additionally, you could owe state tax on any investment earnings, even if small. The result is that the net benefit is zero or negative once all state-level mechanics are considered. Building on that, here is a practical checklist. First, confirm the federal $10,000 K-12 rule. Second, verify whether your state treats K-12 withdrawals as qualified. Third, determine if your state will recapture any deduction or credit when funds are used quickly for K-12. Fourth, estimate possible state tax on earnings in a non-conforming scenario. Fifth, compare the net outcome to paying tuition directly. Finally, if college savings are lacking, prioritize long-term funding for higher education. Now for a quick knowledge check. The question asks, which statement best describes recapture in the context of 529 plans and K-12 tuition? Option A says it is a bonus for using funds quickly. Option B says it is a federal penalty. Option C says it is a state requiring repayment of a prior deduction or credit when funds are used in a non-conforming way. Option D says it is a plan fee. You may pause the video now to consider your answer. We will discuss the answer in the next section. The correct answer is C. Recapture is a state-level mechanism that reclaims a tax break previously granted when a taxpayer uses funds in a manner the state does not consider qualified. It is not a federal penalty or a plan fee, nor is it a bonus. Here is the second question. If your state provides a $10,000 contribution deduction worth 5%, but requires recapture for K-12 withdrawals made shortly after deposit, what is the likely net state tax benefit of an immediate in-and-out K-12 strategy? The options are $0 with potential taxation of earnings, a $500 guaranteed savings, a $500 guaranteed loss, or that it depends only on federal rules. Please pause the video to think about this. We will discuss the answer next. The correct answer is A. The recapture requirement neutralizes the initial state tax benefit, and in many cases, state tax on earnings may also be due. Therefore, the net result is often zero or slightly negative after considering earnings taxes and administrative burdens. As we transition into guidance, the general advisory consensus is to prioritize college savings when those accounts are underfunded. College costs are typically higher, and the longer time horizon enables compounding within the 529. In contrast, short-term K-12 uses can be fragile due to state conformity gaps and the risk of recapture, reducing or eliminating the expected benefit. To consolidate our learning, remember these core points. The federal K-12 allowance is limited and does not compel states to conform. Recapture can reclaim state tax benefits for quick K-12 withdrawals. State taxes on earnings can further erode any advantage. If your college savings are behind, prioritize long-term accumulation for higher education. And above all, verify your state's specific rules before proceeding. In summary, 529 plans are strongest when used for college. Although K-12 use is federally allowed, it is fragile at the state level. Immediate contribution and withdrawal strategies often yield zero or negative net benefit after recapture and state taxes on earnings. Therefore, run a net benefit estimate, verify your state's written guidance, and use the checklist to decide whether to proceed or simply pay the school directly. Finally, a brief but important disclaimer. This video is for educational purposes only and does not constitute tax, legal, or financial advice. Always consult a qualified professional and confirm your state's most current rules before making any decisions involving 529 plans and K-12 tuition. As we wrap up, thank you for watching. If you found this helpful, please like the video, share it with someone planning education expenses, and subscribe for more clear, practical breakdowns. I would love to hear your experiences, so tell us your state and what you discovered in the comments.